In 1993, a financial product was invented that quietly changed the lives of millions of ordinary people. It wasn't a get-rich-quick scheme. It wasn't available only to the wealthy. And it didn't require a finance degree to understand. Today, this product manages over $10 trillion worldwide. Warren Buffett recommends it. The world's biggest pension funds use it. And yet, most people under 30 have never bought a single one. In the next 12 minutes, I'm going to show you exactly what it is, how it works, and why it might be the most powerful financial tool available to you right now. Today we are covering ETFs, also known as exchange-traded funds. We will cover everything from what an ETF actually is, to how to pick the right one, to the mistakes that cost investors thousands. Let's get into it. Here's everything we'll cover today. I know this looks like a lot, but each section is short, clear, and directly useful. By the end of this video, you will understand ETFs better than 95% of people your age. Let's start at the very beginning. What is an ETF? ETF stands for Exchange Traded Fund. Let's break that down. Exchange, it trades on a stock exchange just like Apple or Tesla. Traded, you can buy and sell it anytime the market is open. Fund, it holds a collection of many different investments inside it. So when you buy one ETF, you're not buying one company. You're buying a small piece of hundreds, sometimes thousands, of companies all at once. Think of it like this. Instead of buying one apple from one tree, you're buying a basket of fruit from an entire orchard. If one apple goes bad, it barely affects your basket. That's the power of an ETF. Now let's compare ETFs to the alternatives. Single stocks, you're betting on one company. If Tesla drops 40%, your investment drops 40%. No safety net. Mutual funds, similar to ETFs in that they hold many investments. But they're managed by humans. They cost significantly more in fees, and you can only buy or sell them at the end of the trading day. ETFs give you the best of both worlds. The diversification of a mutual fund, the simplicity and real-time trading of a stock, and the low cost that neither stocks nor mutual funds consistently offer. That's why ETFs have exploded in popularity over the last 20 years. Here's how an ETF actually works behind the scenes. Step 1. Someone defines a strategy. For example, we want to track the 500 biggest companies in America. Step 2. A fund manager goes and buys shares of all 500 of those companies. Step 3. This bundle of shares gets listed on the stock exchange as a single product, the ETF. Step 4. You buy a share of that ETF with as little as $50. And now you own a tiny piece of all 500 companies. When Apple goes up, your ETF goes up a little. When Amazon grows, your ETF grows a little. You're participating in the growth of the entire American economy with one simple purchase. That's the magic of an ETF. There are 6 main types of ETFs, and it's important to understand what each one does. Index ETFs are the most popular. They simply track an index like the S&P 500 or MSCI World. These are the ones most finance experts recommend for beginners. Sector ETFs focus on one specific industry, like technology or healthcare. They can outperform the market, but also underperform. Bond ETFs invest in bonds instead of stocks. They're more stable but grow slower. Commodity ETFs track physical goods like gold or oil, useful as a hedge against inflation. Dividend ETFs focus specifically on companies that pay regular dividends, great for generating passive income. And thematic ETFs invest in future trends like artificial intelligence, clean energy, or robotics. High potential, but also higher risk. My recommendation for most people, start with a broad index ETF. Get comfortable, then explore. Let's talk about what many consider the most important concept in investing, diversification. If you put all your money into one stock and that company has a bad year, you lose big. Think about Enron in 2001. Investors who had everything in Enron lost everything. But investors who held a diversified index fund during that same period, they barely noticed. Because when one of 500 companies struggles, the other 499 carry on. Diversification doesn't eliminate risk, but makes catastrophic loss almost impossible. And that's what an ETF does automatically, just by its design. You get instant diversification the moment you buy it. Now let me show you why ETFs are so powerful with real numbers. If you invest just $100 a month into a broad index ETF with an average return of 7% per year, which is the historical average of the S&P 500, here's what happens. After 1 year, you've invested $1,200 and you have $1,244. Not exciting yet. After 5 years, you put in $6,000. You have over $7,000. After 10 years, $12,000 invested, $17,000 back. Now it gets interesting. After 20 years, $24,000 invested, $52,000 back. You more than doubled your money. But 30 years, you put in $36,000. You have nearly $122,000, $86,000 of free profit from $100 a month. That's not a trick. That's compound interest. And an ETF is the vehicle that makes it possible. Look at this chart. This is compound interest in visual form. In the early years, the growth looks boring, almost nothing. But around year 15, something magical happens. The profit you've already earned starts earning its own profit, and then it accelerates. The line goes from slow and flat to steep and dramatic. This is why financial experts say, start early. Not because the returns are better when you're young, but because time is the multiplier. Every year you wait is not just 1 year of returns lost. It's the compounding on those returns and the compounding on those compounds. Time is literally the most valuable asset in investing. How do you actually pick a good ETF? There are 5 things to check. First, what index does it track? The index tells you what the ETF invests in. S&P 500 means the 500 biggest American companies. MSCI World means over 1,500 companies from 23 developed countries. Know what you're buying. Second, the expense ratio, also called TR. This is the annual fee the fund takes from your investment. Under 0.5% is good. Under 0.2% is excellent. Anything over 1% is a red flag. Third, fund size. Look at how much money is invested in this ETF. Bigger funds are more stable and less likely to be shut down. For billion or more is a good sign. Fourth, accumulating versus distributing. An accumulating ETF automatically reinvests all profits back into the fund. A distributing ETF pays them out to you as cash. For long-term growth, accumulating is almost always better because of compound interest. And fifth, physical versus synthetic replication. Physical means the fund actually owns the stocks. Synthetic uses financial contracts to mirror the index. For beginners, physical replication is simpler and safer. Let me walk you through some of the world's most popular ETFs so you can see what a real option looks like. The iShares Core MSCI World is arguably the most recommended beginner ETF in Europe. It tracks over 1,500 companies across 23 developed countries and costs just 0.2% per year. The Vanguard S&P 500 is America's favorite. It tracks the 500 biggest U.S. companies and charges an incredibly low 0.07% annually. The iShares MSCI Emerging Markets ETF gives you exposure to fast-growing economies like China, India, and Brazil. Higher risk but higher potential. The Invesco QQQ tracks the NASDAQ 100, the biggest tech companies, and has returned around 400% over the last 10 years. Impressive, but also more volatile. And for those interested in sustainability, the iShares Global Clean Energy ETF focuses on renewable energy companies. Important disclaimer, none of this is financial advice. These are examples for educational purposes only. Always do your own research. Okay, let's actually buy one. Step 1, choose a broker. A broker is a platform that lets you buy and sell investments. In Europe, popular options include Trade Republic, Scalable Capital, and DeGiro. In the US, Fidelity, Schwab, and Interactive Brokers are solid choices. Step 2, open and verify your account. This usually involves uploading your ID and takes 1 to 3 business days. Step 3, deposit money. Most modern brokers let you start with as little as $1 or €1. Step 4, search for your chosen ETF. You can search by name or use the ISIN, a unique identifier for every fund. Step 5. Decide between a one-time purchase or a savings plan. A savings plan lets you automatically invest a fixed amount every month. Perfect for building wealth over time. Step 6. Buy it and hold it. Place your order. Then do nothing. Do not check it every day. Do not panic when it drops. Just hold. Let's talk about fees, because this is where many investors silently lose thousands of dollars. Every ETF has what's called a total expense ratio, or TER. This is the annual fee taken from your investment to cover the fund's operating costs. It's deducted automatically and doesn't show as a separate charge. It's just already in the fund's performance. For index ETFs, a TER under 0.5% is acceptable. Under 0.2 is excellent. Now here's why this matters. If you invest $10,000 for 30 years with a 0.2% TER, you end up with around $71,000. With a 1.5% TER, you end up with $48,000. That's $23,000 gone. Not to bad investments, to fees. Fees are the silent killer of long-term returns. Always check before you buy. Now the mistakes. And these are real. I see people make these constantly. Mistake 1. Waiting for the market to crash before investing. Here's the problem. Nobody, not Warren Buffett, not Goldman Sachs, not anyone, can reliably predict when markets will crash or recover. While you wait, the market might go up another 30%. Timing the market always beats timing the market. Mistake 2. Checking your portfolio every single day. Markets go up and down constantly. This is normal, but daily checking triggers emotional decisions. You see a 5% drop and panic sell, locking in losses on what would have recovered in 3 months. Mistake 3. Buying too many ETFs thinking more is better. It's not. 10 ETFs often track similar companies and your diversification barely improves. 1 or 2 broad world ETFs is genuinely enough. Mistake 4. Choosing based on recent performance. An ETF that returned 40% last year is not guaranteed to repeat that. In fact, it might be overdue for a correction. Mistake 5. Stopping your contributions when markets drop. This is backwards. When prices fall, your monthly investment buys more shares. A market crash is a sale. Keep buying. And mistake 6. Waiting until you have more money. Start with €10 a month if that's all you have. The habit and the compounding are more important than the amount. People always ask me, should I invest in ETFs, crypto, or real estate? Here's the honest comparison. ETFs are accessible from $1, highly liquid, moderately volatile, and have historically returned 7 to 10% per year. They require almost no effort to maintain. Crypto is also accessible from $1, very liquid, but extremely volatile. Returns are unpredictable. You can make 300% or lose 80% in the same year. Real estate offers stable returns and leverage, but requires significant starting capital, is illiquid. You can't sell a house in 5 minutes, and requires active management. My honest take, for most people, especially under 40, a broad index ETF is the most efficient, accessible, and reliable wealth-building tool available. That doesn't mean the others are worthless. But ETFs are where you should build your foundation. Let me show you what different investment levels look like over time. If you invest $50 a month, which is about 1 cappuccino a day, and achieve a 7% annual return, after 30 years you have $61,000. Not bad for a cappuccino. $200 a month gives you $244,000 after 30 years. $500 a month? Over $600,000. Now here's the important thing. These numbers assume you never increase your contributions. As your income grows and you can invest more, the numbers grow even faster. Pick an amount that's sustainable for you right now, even if it's $20. The key is consistency. Invest every month, no matter what the market is doing, no matter what's happening in the news. Set it up as an automatic savings plan and forget about it. Let time do the work. Taxes. Not the most exciting topic, but potentially one of the most expensive if you ignore it. When you sell an ETF for a profit, most countries will tax that gain. In the US, long-term capital gains are taxed between 0 and 20% depending on your income. In Germany, It's 25% plus a solidarity surcharge. In the UK, it depends on your income and allowances. The key is to use tax-advantaged accounts wherever possible. In the US, maximize your 401k and IRA before investing in a regular brokerage account. In the UK, use your ISA allowance. In Germany, set up a Freistellungsauftrag to protect your first €1,000 of gains annually. And if your ETF is accumulating, meaning it reinvests profits automatically, some countries still apply a tax on theoretical gains even if you haven't sold anything. This is called a fictitious gains tax. Know your country's rules. Tax is not a reason not to invest, but it is a reason to invest smart. Consult a local tax advisor for your specific situation. Let's bring everything together. An ETF is a basket of investments that gives you instant diversification with a single purchase. Index ETFs, specifically those tracking the MSCI World or S&P 500, are the best starting point for most people. Time and consistency beat everything else. $100 a month for 30 years beats $10,000 invested once and forgotten. Always check fees. Aim for under 0.5% annually. Don't panic when markets drop. They always have, and they always recovered. And last, start now. Not next month. Not when you have more money. Today, even if it's $1. The habit is worth more than the amount. You now know more about ETF investing than the vast majority of people. The only question that matters is what you do with that knowledge. That's your complete guide to ETF investing. If this video helped you understand something that used to feel confusing, please leave a like. It helps this channel reach more people who need this information. Subscribe for a new finance video every single week. And drop a comment below. I want to know, what's going to be your first ETF? Or if you already invest in ETFs, what's in your portfolio? See you in the next one.